Good morning and welcome to the Global View on this Friday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz as we get across what happened on global markets overnight. They did fall heavily while oil prices surged as hopes for an imminent end to the war in the Middle East faded. This is despite President Trump saying talks with Iran were going very well while he said he was pausing attacks on Iran's energy plants for 10 days. And worries about persistent inflation drove US Treasury yields higher and pushed Wall Street's main indices sharply lower, with the Nasdaq now in correction, having fallen more than 10% from its record high 5 months ago. The energy sector was the biggest gainer, while tech stocks were sold off. In particular, chip stocks tumbled after 3 sessions of gains, with AI chip heavyweight Nvidia leading the losses. Micron Technology, Western Digital, SanDisk also extending their losses. Meta and Google parent Alphabet were also under pressure after the US court found the social media giants were liable for harming children, sparking concerns for investors that they may have to overhaul their business models. US listed shares of the gold miners tracked bullion prices lower, while US listed shares of BHP and Rio also ended in the red. Well, President Trump has said he's pausing attacks on Iran's energy plants for 10 days to Monday, April 6th, at the Iranian government's request. He also said talks are ongoing, and despite erroneous statements to the contrary by the fake news media and others, they are going very well. Well, the Iranian regime has labelled a US proposal for ending the war, which is now 4 weeks old, as one-sided and unfair. Meanwhile, the OECD has warned that the escalating conflict has knocked the global economy off a stronger growth path. It projects that global GDP growth will now ease from 3.3% last year to 2.9% in 2026, before edging up to 3% next year, as an energy price surge and the unpredictable nature of the conflict offset tailwinds from strong technology-related investment. OECD Chief Mathieu Savary, the former Australian government minister, saying there's a high level of uncertainty around the duration and the magnitude of the current conflict in the Middle East, and that means that this outlook is subject to significant downside risks that could result in lower growth and higher inflation. Well, US Treasury yields rose further. The US 2-year up to 3.98%. The 10-year was at 4.42%. Australian 3-year government bond yields rose to 4.81%. The 10-year has jumped to 5.11%. The US dollar index up around 1/3% on the day. The Aussie has tumbled below 69 US cents. And crude oil prices have rebounded from the previous session's losses as hopes for a swift end to the war in the Middle East faded. Brent futures rising close to 6% to $108 a barrel, with Brent currently down at just over 105. Gold retreated as the US dollar rose, along with oil prices, which have stoked inflation fears. Spot gold around 3% lower, currently at around $4,400 an ounce. And Bitcoin is trading around 69,000 US dollars. All right, let's now get across what we're seeing with a focus more globally. Mathieu Savary is the Chief Investment Strategist ex-US at BCA Research. He joins us now. Mathieu, good to catch up with you. It's been quite some time since we've had a chat. Of course, comes at a critical time for the global economy at the moment, as we just heard from the OECD. They're expecting this crisis, higher fuel prices, to hit global economic growth. How do you see it?
Yeah, at this point in time, it's unavoidable that global growth will be hit, given that energy prices have risen tremendously. It's not just energy, we're also set to see shock in terms of food prices due to the increase in fertilizer prices. And on top of it, we are in an environment where there is a lack of barrel of oils taking place right now, which mathematically will hit economic activity. The key question, though, is how quickly the Strait of Hormuz reopens, because if this mess lasts longer, significantly longer, then it's not just a slowdown that we'll be talking about. It's a full-fledged stagflationary environment with contracting growth and significantly higher inflation.
Given those rising fuel prices, how do you see that affecting particularly those economies that are net oil importers, particularly in Europe and also in North Asia?
Yeah, so those economies are likely to be the one hit the hardest in the near term, simply due to the fact that whether it's Europe or Japan, Japan even more than Europe, honestly, they are highly dependent on imported energy. And on top of it, those economies are very dependent on trade. Hence, if, as the OECD forecast, we do see a slowdown in global growth, not only will those economies suffer because their input costs have increased, but they will also suffer because demand will go down. Now, there are some potential offsets. We're starting to see news out of Spain and Germany that the governments there will put in place some programs to limit the impact of the rise of fuel on the consumer. I would expect similar measures out of Japan as well, but nonetheless, the environment points towards slower growth for them right now. And again, if the conflict lasts, an outright recession.
If the conflict lasts, no one knows, do they? And well, perhaps not even President Trump himself, obviously giving some very mixed signals as to when it is likely to end as he tries to find an off-ramp. Have you done some modelling there, Mathieu, just as far as perhaps the best and worst case scenarios in terms of the duration of this conflict?
Yes, my colleagues who cover the global commodity markets have come up with estimates that until, if the conflict and specifically the closure of the Strait of Hormuz ends before April 19th, approximately, we're more in the slowdown scenario. Because right now, if we take into account the oil that's at sea that is being delivered, the decline in global strategic reserves of energy, the shortfall in supply versus demand is around 4.5 to 5 million barrels per day, which is significant, but it's in the middle of previous disruption that we've seen in the past. However, after April 19th, we enter an environment where the crude at sea will have dwindled very significantly. And then the loss of crude is around 9.5 to 10 million barrels per day. And in this context, a severe recession becomes unavoidable because the demand for oil will need to fall very significantly. And what we are estimating here is that based on the normal elasticity of demand to the price of oil, to get the necessary contraction in oil, we need to see oil prices go to roughly $200 per barrel, which pretty much guarantees a terrible outcome because A, it's an energy shock in and of itself, and B, we will see global central banks increasing interest rates significantly, which the market is already sniffing out right now and probably greatly contributing to the weakness in stock prices.
Yeah, obviously we've heard central banks globally pivot to a very hawkish outlook as a result of what's going on. Mathieu, that said though, given the crisis, do you see some opportunities there in terms of investing right now?
In the near term, our preference within BCA Research, and something we just discussed again this morning, is cash, to be honest with you, because the uncertainty is so high that the optionality offered by holding cash is very valuable. However, we do think that the current conflict is strengthening some underlying trends in the global economy, namely what we see as conditions for a global capex boom, because Western economies are A, engaging in rearmament, B, re-emphasizing rebuilding their global supply chains, wanting to be more robust in the face of those kinds of shocks. So this means that once the dust starts to settle, what we'll be looking to load up on is assets like industrials and financials in Europe, in Japan, that will be the main beneficiary in this environment. However, if we get into a more recessionary environment, because the Strait of Hormuz remain closed, I think the trade ahead of buying those risk assets would be to buy the yen. We will benefit from its hedging ability for the recession risk, and be bonds, especially in the UK, where recession risk is very elevated, will soon start to be very appealing assets for investors.
And Mathieu, if you want to be more conservative and take a defensive stance, where can you hide at the moment in terms of those assets?
That's the problem. That's why we have this preference for cash, because what we're seeing is that none of the safe haven have worked. The US dollar to some degree has benefited, but honestly, the performance of the US dollar has been quite tame in comparison to the size of the shock, and also to the benefit that would be imbued for an economy that is less exposed to an energy shock, like is the case for the US dollar, which is why we think that at this point in time, it's all about cash. Because ultimately, when we are entering a stagflationary environment, which is what the market is trying to price in right now, nothing works well. Not bonds, not gold, absolutely nothing. Once the crisis part is over, then it makes sense to deploy capital in traditional safe haven like bonds, even gold. But when we are in the first phase of an oil shock, none of those assets have historically worked well as protectors.
Mathieu, thanks so much for joining us from BCA Research.
Thank you for having me.
Let's turn our attention to the local market then. Ahead of the open, just a couple of minutes away, as you can see, looks as though we're in for another bout of heavy selling. S&P ASX 200 there, futures down 1.1%, reflecting those losses we saw on global markets overnight. In particular, the Nasdaq, which lost about 2.4% to the point where it is now in correction territory. It's off about 11% from its highs 5 months ago. Stay with us. The open just around the corner.